Wall Street expects hot oil prices to cool down. Crude oil wrapped up its strongest quarterly increase since the early stages of the Ukraine conflict, but Wall Street anticipates the rally's longevity to be limited, with elevated prices now impacting demand. In Q3, the front-month WTI crude oil recorded its strongest performance since Q1 2022, rising by 28.5% to reach $90.79 per barrel. Similarly, front-month Brent crude oil also ended the quarter with a gain of 27.2% at $95.31 per barrel. Energy sector stocks had a strong quarter, with the SPDR S&P Oil and Gas Exploration and Production ETF, XOP, gaining 17%. Unless there is a supply crisis, most analysts do not anticipate oil prices remaining above $100 per barrel in the short term. Instead, the consensus among analysts is that prices are likely to stay around $90 for the remainder of the year. Long-standing oil bull Goldman Sachs is forecasting an average fourth-quarter price of $88 a barrel for U.S. crude. Higher prices are denting demand. Americans are driving and flying less, says J.P. Morgan, because of elevated gasoline and jet fuel prices. Gasoline consumption dropped in July month-on-month more than it usually does, the bank said, and airlines recently reported sales at the lower end of expectations. Demand risks are shifting to the downside. With pump prices surging and a seasonal travel peak now behind us, a greater share of demand in the fourth quarter will be concentrated in sectors more sensitive to economic growth, wrote Natasha Koneva, head of the Global Commodity Strategy team at J.P. Morgan, in a note last week. Chinese demand growth, driven largely by millions of travelers taking to the skies as Beijing relaxed travel restrictions, is also waning. Jet fuel consumption has nearly recovered to its pre-pandemic level. China has started tapping into its own crude inventories, ramping up refinery runs and exporting more fuel. China is able to do this, and profit in the process, said Citi's global head of commodity strategy Ed Morse, because of the enormous crude oil stockpile the country amassed over the past 3 years by buying cheap crude, most recently from Russia and Iran. What they've done is mind-boggling, Morse said. They are as significant in the market in a way as OPEC. According to UBS analysts, elevated oil prices are expected to prompt U.S. producers to increase production, despite the fact that the count of active rigs specifically focused on oil in the U.S. has fallen to its lowest level since February 2022. At some point, Saudi Arabia may seek to reduce prices by utilizing its substantial spare crude capacity, which has been built up through production cuts. Riyadh is reaping favorable revenues with prices where they are now, said Rebecca Babin, senior energy trader at CIBC Private Wealth, and worries about the damage that higher prices could do. I think they've learned the hard way that letting prices rip higher and the long-term demand destruction that follows isn't worth it, Babin said. The potential for speculators to power the market higher is limited, say some analysts. Money manager positions are already the most bullish they have been in more than 3 years, according to Standard Chartered. Consumers, producers and merchants anticipated the tight market and bought ahead of the run-up, said Daniel Gali, a commodities strategist at TD Securities. They were well positioned for it, said Gali. Ultimately, I think that caps the rally. Energy, XLE, was the S&P's only positive sector this week, finishing plus 1.6%.